Lehman Brothers, lessons from the collapse that shook the world. It was the day Wall Street stopped breathing. September 15th, 2008, a Monday that changed the world. When Lehman Brothers collapsed, the financial heart of the modern age skipped a beat. What began as whispers of trouble in the markets turned into a shockwave that circled the globe, shaking banks, governments, and millions of lives. The fall of Lehman Brothers was not just a corporate failure. It was a symbol of greed, of ambition, of blind faith in a system that believed it could never fall. But to understand how one of the world's most powerful investment banks could vanish overnight, we must go back more than a century and a half. The roots of an empire. In 1850, three brothers, Henry, Emmanuel, and Mayer Lehman, arrived in Montgomery, Alabama. They were immigrants from Germany, young and hungry for opportunity. Their business began modestly, a small dry goods store. But soon, the brothers saw something bigger than fabric and cloth. They saw cotton, the lifeblood of the American South. They began trading cotton, linking farmers with markets, and money began to flow. By the mid-19th century, the Lehman name had become known not just in Alabama, but across New York, the center of America's growing financial world. The brothers evolved from merchants into brokers, and from brokers into bankers. Through the Civil War, the Great Depression, 2 world wars, Lehman Brothers endured. The firm transformed itself, decade by decade, into a pillar of Wall Street. It financed industries, advised governments, and helped shape the architecture of modern finance. By the late 20th century, Lehman Brothers had become a global powerhouse. In 1994, after being spun off from American Express, it stood proudly independent, with its own name, its own empire, and its own ambitions. Inside its glass towers in Manhattan, Lehman's culture grew bold. Some would say fearless. It survived crises that destroyed others. And by the early 2000s, it was thriving once again. With more than 28,000 employees and assets worth over $600 billion, Lehman Brothers was not just a bank. It was an institution that seemed invincible. But beneath that success lay something dangerous. A quiet storm forming deep inside the global economy. Because by the dawn of the new millennium, the rules of finance had begun to change. And Lehman Brothers, once cautious and conservative, had begun to play a very different game. This is where the story turns, where ambition starts to blur into overconfidence, and where the seeds of collapse begin to take root. Strategic vulnerabilities, the seeds of collapse. In the glittering years of the early 2000s, Lehman Brothers stood tall among giants. Its profits soared, its reputation gleamed, and its leaders believed they had mastered risk itself. But inside the polished corridors of its New York headquarters, something was changing. Lehman had begun chasing growth at any cost. Its executives were no longer content with steady returns. They wanted dominance. And to get there, they turned to the one market that promised endless riches: real estate. At the time, America was living through a housing fever. Home prices were rising year after year. Banks, investors, and regulators all believed that property values could only go up. It was a belief that would soon prove catastrophic. Lehman plunged deep into this boom. It began buying mortgage lenders like PNC Mortgage and Aurora Loan Services, turning them into engines of profit. But these weren't ordinary loans. Many were high-risk, subprime mortgages given to borrowers with little ability to repay. Lehman packaged those loans into complex financial products, mortgage-backed securities, collateralized debt obligations, and sold them to investors around the world. It was a gold rush built on debt, and Lehman was one of its most aggressive prospectors. By 2007, the bank's leverage, the ratio of what it owed to what it owned, had exceeded 30 to 1. For every dollar of real capital, it was borrowing 30 more. That meant even the smallest decline in the value of its assets could destroy its equity. Lehman had become a tower of glass built on a paper foundation. The risks didn't end there. Behind the scenes, the bank used accounting maneuvers known as Repo 105, transactions designed to temporarily move billions of dollars off its balance sheet, making it appear healthier than it was. Technically legal, but deeply misleading. It was, in effect, a magician's trick, hiding the danger in plain sight. The broader system encouraged this recklessness. Regulators had relaxed oversight. The repeal of the Glass-Steagall Act had blurred the lines between commercial and investment banking. Cheap credit flooded the markets, and investors, intoxicated by years of easy profits, stopped asking hard questions. Lehman wasn't alone. Every major Wall Street firm was playing the same game, but Lehman's bets were larger, its leverage higher, its exposure deeper. Inside the company, warning signs flashed red. Risk limits were breached repeatedly, more than 40 times, according to later investigations, yet no one was held accountable. The culture rewarded short-term gain over long-term caution. As one insider later said, at Lehman, the fear wasn't losing money, it was missing out on the next big deal. By mid-2007, the cracks had begun to show. The subprime mortgage market started to crumble, and the first tremors reached Wall Street. But Lehman's leadership pressed on, convinced the storm would pass. They were wrong. The collapse. When the system broke. By mid-2007, the music had started to fade. The American housing market, once the golden engine of endless growth, began to stall. Homeowners could no longer keep up with payments. Defaults were rising, foreclosures spreading, and the mountain of mortgage debt that Wall Street had built its fortunes on began to crack. For Lehman Brothers, the pressure was immense. In August 2007, it shut down its subprime lender, BNC Mortgage, an early sign that the foundation was giving way. But the company's leaders insisted it was just a temporary storm. They believed their models, their diversification, their history of survival. They believed Lehman was untouchable. Behind closed doors, the numbers told another story. Billions in mortgage-backed assets were losing value by the day. The balance sheet was bloated, liquidity shrinking. Initial alarms rang, but the response was denial. Even as limits were breached and risk spiraled out of control, management pressed forward, desperate to project confidence. As 2008 dawned, the illusion could no longer hold. The cracks widened into chasms. In June, Bear Stearns, another Wall Street titan, collapsed and was sold in a fire sale rescue. Markets panicked. If Bear could fall, who was next? The answer came swiftly. By the summer of 2008, Lehman's losses were undeniable. The firm posted a $3.9 billion quarterly loss and wrote down more than $5 billion in toxic mortgage assets. Investors fled. In a single week, its stock plunged by 77%. Credit default swaps, the market's insurance against default, surged, signaling what everyone now feared. Lehman was dying. Desperate, the company searched for a savior. Meetings stretched late into the night. Talks with a Korean development bank collapsed. Potential buyers circled, Barclays, Bank of America, but the deals slipped away. Confidence evaporated, and without confidence, a bank cannot survive. Then came Monday, September 15th, 2008. In the early hours before dawn, Lehman Brothers Holdings filed for Chapter 11 bankruptcy protection in New York. It listed $639 billion in assets and $613 billion in liabilities. At that moment, Lehman became the largest bankruptcy in American history. The images from that day remain haunting. Employees carrying boxes out of headquarters, traders watching in disbelief as their screens turned red, and the world's markets trembling as a pillar of global finance simply ceased to exist. The shock waves were immediate. Stock markets plunged around the world. Banks stopped trusting each other. Credit markets froze. Within days, trillions of dollars in global wealth had vanished. Governments and central banks scrambled to contain the damage. But one question echoed through every newsroom and trading floor. Why had the U.S. government, which had rescued Bear Stearns just months earlier, chosen not to save Lehman Brothers? There were many answers, and none. Some said it was about moral hazard, that the era of bailouts had to end. Others believed the problem was simply too large to fix. And some, years later, would argue that it was a catastrophic mistake, the spark that turned a crisis into a global financial inferno. Whatever the truth, the decision not to rescue Lehman Brothers marked a turning point in history. It shattered the illusion that any institution was too big to fail, and in doing so, it unleashed a storm that would sweep across the entire world. Root causes. Inside the fall. The fall of Lehman Brothers didn't happen overnight. It was years, even decades, in the making. A slow, silent buildup of pressure beneath the surface of a gleaming empire. And when that pressure finally broke, it revealed something far more dangerous than one bank's failure. It revealed the fragility of the entire financial system. At the heart of Lehman's downfall lay one fatal word: leverage. By 2007, the firm was borrowing more than $30 for every dollar it actually owned. It was a structure that magnified profit, but also magnified loss. A small drop in the value of its assets could wipe out its capital completely. In essence, Lehman had been balancing on a razor's edge. Its business model depended on short-term borrowing, overnight loans, repurchase agreements, commercial paper. Every morning, it needed to refinance billions just to keep operating. When markets were calm, that system worked. But when fear began to spread, those lifelines were the first to be cut. Creditors pulled away, and the oxygen that sustained Lehman's empire disappeared almost instantly. Then came the mortgages, the toxic heart of the crisis. Lehman's deep exposure to real estate, especially subprime and commercial mortgage-backed securities, made it fatally vulnerable. As housing prices fell, the value of those securities plunged. Losses compounded, and the more asset values dropped, the higher Lehman's leverage effectively became, a vicious spiral that could not be stopped. Inside the firm, the culture rewarded aggression. Bonuses and promotions were tied to short-term profits, not long-term prudence. Executives were celebrated for taking bigger risks, for chasing bigger deals, for pushing boundaries. Caution was weakness. Profit was glory. Even when internal risk limits were breached, 44 times by some counts, no real action was taken. Warnings were ignored, and those who questioned the strategy were sidelined. Then there was Repo 105, an accounting trick that will forever stain Lehman's legacy. Through these temporary transactions, billions in liabilities were moved off the books at the end of each quarter, creating the illusion of strength. On paper, the firm looked healthy. In reality, it was gasping for air. The Valukas report, published after the bankruptcy, would later call these practices deceptive, a manipulation of truth designed to mislead investors, regulators, and even the board itself. But Lehman was not alone in its blindness. Regulators failed to see the full picture. Credit rating agencies stamped high grades on securities that were little more than sandcastles. Auditors, politicians, and even investors all played their parts in a wider failure, a system built on optimism and denial. When Lehman finally fell, the consequences were devastating. The interconnections between global banks meant the collapse rippled instantly across continents. Credit markets froze. Banks hoarded cash. Businesses could no longer borrow. The global economy, once roaring, began to suffocate. Within months, the world plunged into what would be called the Great Recession. Trade slowed. Unemployment soared. Millions lost their homes, their savings, their confidence. The dream of perpetual prosperity had shattered. Lehman's bankruptcy process would drag on for more than a decade. Across multiple countries and court systems, lawyers untangled a web of claims and losses so vast it defied comprehension. In the end, roughly $115 billion was returned to creditors, only a fraction of what was lost. Some investors recovered 40 cents on the dollar. Others, nothing at all. The collapse exposed a painful truth. Modern finance had outgrown the systems designed to control it. It had become too complex, too interconnected, and too dependent on trust that vanished the moment fear took hold. Lessons learned, echoes of a collapse. The story of Lehman Brothers does not end with bankruptcy filings or court documents. It ends with lessons, hard, unforgettable, and urgent for anyone who dares to play in the world of finance. First, leverage matters. High borrowing can multiply profits, but it also multiplies risk. A single misstep in a fragile system can erase decades of growth in a heartbeat. Lehman's story reminds us that even the mightiest institutions are vulnerable when they depend too heavily on debt. Liquidity is just as critical. A firm may appear strong, but if it cannot meet its obligations on time, collapse is inevitable. Lehman relied on short-term funding to fuel long-term investments, a dangerous imbalance that left it exposed to panic and withdrawal. Transparency and governance are not optional. When management hides liabilities, manipulates figures, or ignores warnings, trust evaporates. The Repo 105 maneuvers were more than accounting tricks. They were a breach of faith. Without clarity and oversight, no system, no matter how sophisticated, can withstand stress. The collapse also showed the power of interconnectedness. The fall of one institution can trigger a chain reaction across markets, countries, and continents. Systemic risk is real. It is not hypothetical. It is a force that can turn a single failure into a global crisis. And finally, culture shapes risk. When bonuses reward short-term gain over long-term stability, when ambition blinds leaders to danger, failure is inevitable. Lehman's management pursued growth with relentless fervor, ignoring the storm gathering around them. The consequences of that culture would be felt by millions far beyond the walls of the bank. In response to Lehman's collapse, governments and regulators acted. The Dodd-Frank Act in the United States reformed banking oversight. Living wills were introduced to plan for orderly resolution of failing institutions. Capital requirements were raised. Systemic risk became a watchword, and stress testing became standard practice. Yet, even with reforms, the questions remain. Can markets ever be fully safe? Can systemic risk ever be eliminated? Or is risk and the fragility of confidence an inherent part of the financial system? Lehman Brothers is more than a cautionary tale. It is a mirror reflecting the vulnerabilities of modern finance. It is a reminder that ambition unchecked, leverage uncontrolled, and oversight absent can bring down even the most storied institutions. On September 15, 2008, a titan fell, and the world watched as the illusion of invincibility crumbled. But Lehman's legacy endures, in the lessons it taught, in the reforms it inspired, and in the memory of what happens when power, pride, and risk collide. The rise and fall of Lehman Brothers reminds us that no empire is invulnerable, no market is immune, and no lesson should ever be forgotten.